If you're broke in 10 years, it won't be because you didn't work hard, it'll be because you made dumb money decisions that no one warned you about. Not saving money, that's bad. Spending money to impress people you don't even like, that's even worse. And thinking you'll figure it out later, that's how people stay broke forever. In this video, I'm gonna break down the 7 money decisions that silently destroy your future and how you can avoid every single one of them. Number 1, waiting until you're older to invest. Let me show you why through an example. Person A starts investing $500 a month the day they turn 25, and they invest $500 every single month until they turn 40, and they never invest another penny again after they turn 40, which means over these 15 years, Person A invested $90,000. Person B didn't learn about investing until a little bit later. They started investing the same $500 a month when they turned 40, but then to make up for lost time, they invested from the age of 40 until 65, meaning they invested for 25 years as opposed to 15 years. And so person B invested over the course of their investing career $150,000 out of their pocket. And let's assume that both of them get a 10% return on their money. So person A invests $500 a month, and then at the age of 40, they don't invest another penny, but their money continues to compound and grow. Person B doesn't start investing until 40. They invest more money until the age of 65. Well, at 65, person A is gonna have around $2.2 million, even though they never invested another dollar after they turn 40, while person B will have a little bit under $650,000 when they turn 65 years old, even though they invested way more dollars. The difference here is how much time they had to invest. This person started earlier, so the money had more time to compound and grow. And I get it, it's been a crazy year. It's been a crazy time since 2020. But the reality is what Warren Buffett said, time in the market beats time in the market. The longer your money is in the market, the more time your money has to compound and grow. Nobody knows when a crash is gonna happen. Nobody knows when a recession is gonna happen next. It will happen, and when that recession and crash happens, instead of panicking, use that downturn as an opportunity to buy more instead of running away. Number 2, buying a car you can't afford. The average new car payment in America today is $750 a month, which interestingly, 1 month of the average car payment is more than what my last car was worth when I stopped driving it last year. But now let's do some quick math. If you're paying $750 a month just in your car payment, that means you're paying $9,000 a year for just your car. That doesn't include the insurance or the maintenance or the premium gas. $9,000 a year just in car payments, which means over the next 10 years, you're gonna pay $90,000 in car payments, probably more. And you might say, well, Jaspreet, once I pay off my car, I'm not gonna keep making car payments, when in reality, what ends up happening to a lot of people is you finish paying off that car, then it feels weird not to have a car payment, so now you trade it in to get a new car, and now you get a brand new car payment, and you start the payment cycle again, and usually your car payment goes up because now you wanna upgrade the car because you have a new income, which is why many people are gonna end up paying more than $90,000 over the next 10 years, but I'm gonna be generous. You've paid $90,000 in car payments. This $40,000 car is now gonna be worth somewhere between $5,000 to $10,000 depending on how nicely you take care of this car, which means number 1, you've been paying interest for these last 10 years on number 2, a car that's been losing value, and then number 3, this car has a limited lifespan, because if you hold on to this car for 10 years, well, you might need a new car now, especially if it's not a Toyota or a Honda. But look at what could happen if you did things a little bit differently. If instead of paying $9,000 a year, you took this $9,000 and you used it not as a down payment on a car, but you used it to buy a used car with cash. Yeah, it might not be a BMW or a Lexus, but it'll be a nice, good working condition Toyota Corolla or a Toyota Camry. Now, you get to keep this $9,000 a year in your pocket. There's $750 a month that you can invest. And let's assume now that you're going to invest this extra money instead of giving it to BMW. Now, when you invest this money over the next 10 years, well, this $9,000 a year is not gonna be $90,000 leaving your account. It's gonna mean that you have an investment balance of $150,000. Here you have a car that's worth $5,000 to $10,000 that needs a lot of work. Here you have a 6-figure investment account that you can use to buy yourself a brand new car, or to help buy your retirement. Most people will finance this $40,000 car without blinking an eye. But when it comes to investing your first $1,000, people have a lot of hesitations because what if I lose money? This car is a guaranteed loss. When you're paying interest on it, it's a guaranteed loss 3 times over because you're paying interest on a depreciating liability that has a limited lifespan. And so when you're willing to do this, you should be much more willing to invest your money, because when you lose in your investments, you're learning on how you can win, because that's where your real wealth has been. Again, for those of you that are investors or want to become investors, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we break down what's happening in things like the economy, housing, stocks, crypto, and the global markets into a fun, witty, and easy to read newsletter. It's read by hundreds of thousands of investors every single morning. And when you join Market Briefs, you'll also get my investing masterclass as a bonus, where I'll walk you through how you can get started as an investor and how you can find hidden investment opportunities before everybody else. It's all completely free, so if you want to join Market Briefs and get my investing masterclass, I have the link for you to join down in the description below. Decision number 3 is you're paying the stupid tax. You and your broke cousin Bunty want to go to Cancun. Great. It's going to cost you $8,000. No problem. Now you have 2 options. Option A is you only go if you have the money to actually buy it, which is going to cost you $8,000, the cost of the trip. Option B is you go even if you don't have the money and now you finance it, and it's going to cost you $25,000 because you financed it. Now you might look at this and say, Jaspreet, this is a pretty obvious example. Option A is the better option, but the data will disagree. Read this from Credit Karma. 1/3 of Americans plan to swipe their credit cards to pay for their summer plans, and more than a quarter have used or plan to use a payment plan or a buy now, pay later service. Let's do the math on option B, assuming that you finance this trip to Cancun on your credit card. It's an $8,000 purchase with 25% APR, and you're financing it because you don't have the $8,000 to pay it off, and now you make the minimum monthly payments, or a little bit more than the minimum monthly payments, so you're paying $175 a month. Well, now what's going to happen is you're going to end up paying $17,000 in interest alone. When you add the $17,000 in interest plus the $8,000 of the credit card debt that you acquired, meaning the cost of the trip, that means it's a total cost of $25,000 plus years of your life to pay off that 1 week to Cancun with your broke cousin Bunty. Well, look who's broke now. I'm not saying this trying to be mean. I'm saying this to make a point. This is what's called a stupid tax, because you're paying all this extra money, making Amex and Visa rich, when you could be using this money to make yourself wealthier and to give yourself a whole lot more freedom, all just for 1 week of fun. Number 4 is not having extra savings. My wife and I just moved into a new house, and we budgeted for the down payment and the renovations we wanted to do and all the moving costs. But a little while after we moved in, something interesting happened. It was really hot outside, and the AC stopped working. When we bought the house, the AC was working, but now all of a sudden it broke, and it wasn't part of our renovations. And now we have a problem. There's a cost to fix this AC that we didn't budget for. Luckily, we have cash savings which we could fall back on, which meant we don't have to scramble. We don't have to think about which investments would we sell, where would we get the cash, how would we pay for it. We have the savings to fund the repairs quickly. This is why you want to have somewhere between 3 to 12 months worth of expenses put aside in a savings fund, an emergency fund, a rainy day fund, call it whatever the heck you want. It's a bank account that's extra money. This is not money that you're going to use for your investments. This is not money you're going to use to buy a house. This is not money you're going to use to buy a car. This is extra money that's there in case your AC breaks, in case your kid gets sick, in case you get laid off, in case your business goes bankrupt. That if something bad were to happen, you have some extra cash to continue living your life without having to change any of your life. Now, the reason why I say 3 to 12 months worth of expenses, it's a big range, is because you're going to be in a different season of your life than I am. Personal finance is personal. If you're 25 years old, you're not married, don't got any kids, you don't have any financial responsibilities, maybe you only need a couple or a few months of expenses because, well, you could be a lot more aggressive with your investments. If you're 45 years old, you got kids that are relying on you, you have parents that are relying on you, you have more financial responsibilities, you might not feel comfortable with just 3 months of savings put aside. Maybe you need 6 or 9 or 12 months put aside to help you feel comfortable. After 12 months, well, beyond that, I think you should be investing your money. Of course, I'm just a random guy on YouTube, so make sure you always do your own due diligence, but this is where you have to have some extra cash, because sometimes things will go wrong, things will break, and you don't want to scramble when those things happen. And it's even worse when you are investing your money And now things go wrong. You need some money because your AC broke or your car broke down and markets are crashing at the same time. And now you're forced to sell your investments to fund those repairs, and you're selling your investments at a big loss. Don't be forced to do that by having a savings fund. Decision number 5 you want to avoid is buying a house you can't afford. I rented where I lived for a long time, even though I owned rental properties, even though I owned stocks, even though I invested in startups, even though I owned a business, even though my employees were buying houses. I was continuing to rent because, well, it was easier for me. It gave me more flexibility and it gave the ability for me to invest more money into my assets. A lot of people will tell you that you need to buy a house that way you can start building wealth. Well, the way that I look at it is that your house that you live in is not an asset, it's a liability because you have a lot of expenses. You got to pay for the mortgage, you got to pay for the insurance, you got to pay for the property taxes, you got to pay for the upgrades and the maintenance and everything else. And you don't actually make money until you sell, and there's a chance that you don't make money. Versus when I buy a rental property, I'm buying it with the sole purpose of making money. When I buy my house, I'm buying it with the goal of making memories. So when I think about my house, I'm not looking at it as a way to make money, I'm looking at it as an expense. And many people are looking at buying a house as that's the way that you gotta become wealthy. Stop renting, buy where you live, and now when you think that your house is gonna make you wealthy, it's much easier to get you to believe, well, if you're going to buy a house as an investment, might as well buy a bigger house and a nicer house and a more grand house that maybe you can't afford. And now you buy something so big you have no money to actually save and invest into things that will make you wealthy. I'm not against you buying a house. In fact, I think it's a great thing to buy a house. I just want you to be able to afford the house that you buy, and more specifically, being able to afford the house, meaning afford 3 things. Number 1, you got to afford the down payment, afford the monthly payment, and afford the moving costs. What does that mean? When it comes to the down payment, having at least 20% cash to put down to buy the property. When it comes to the monthly payment, what I like to follow is my 75, 15, 10 plan, which says for every dollar that I earn from here on out, 75 cents is the maximum that I can spend, 15 cents is the minimum I invest, 10 cents is the minimum that I save. My monthly payment has to be able to be paid out of the 75%. So if I have enough money to pay for my mortgage, to pay for my property taxes, to pay for my food, to pay for my travel, to pay for everything else out of this, I can afford the monthly payment. As long as I don't have to eat up some of my savings and investments, I can afford the monthly payment. And then when it comes to the moving costs, when my wife and I bought our house, we spent a lot of money on renovations. We did some very extensive renovations that we put money aside for. You might not. You have to know what the costs are going to be to move in. If you're going to be redoing the basement, building a deck, redoing the kitchen, there's a cost to that. If you're going to be hiring movers, there's a cost to that. If you're buying new furniture, there's a cost to that. You have to know what the costs are going to be and make sure you have the money for that, because if you don't, you're going to be slapped with very expensive fees as soon as you bought your very expensive house. Number 6 is trying to look rich. There's a very popular meme of Jay-Z that I'll share on the screen here, comparing him when he was worth $100,000 versus when he was worth $1 billion. And what you'll see is when he's worth that $100,000, he's decked out in jewelry, so he looks like he's super rich and he's made it. When he's worth $1 billion now, he's just wearing his sweater and a black t-shirt, very casual. Because when you're trying to look rich, you make it loud, you make it flashy, so people think that you're rich, but when you actually become rich and you become wealthy, you have nobody to prove it to. Now you're quiet. This is going to be part of your money confidence, because nobody wants other people to think that you're broke. You don't want other people to say, oh, this person's probably struggling with money. But when you know that you're doing things right with your money, when you know that you're saving your money, you're investing your money, and you're slowly starting to build wealth, now you can start building the confidence and say, you know what? I don't care if people judge me. I don't care what people think. Let them to continue to point their fingers and say what they want and live broke, because I'm trying to build wealth for myself and my family. And when you can build that confidence, you can stop spending all that money to look like you're rich, and now you can actually start becoming rich. And the interesting thing about becoming rich is it requires this period of you looking broke, and now when you look broke, you're actually building your wealth. That way you can buy all the nice things that you want and not have to worry about the money. And last but definitely not least is number 7, not asking your boss for a raise. One more time, we're going to demonstrate this through an example. Person A, person B work at the exact same company doing the exact same thing, and they both make the exact same salary of $60,000 a year, and the company is paying out an average of a 2% raise a year. Some years more, some years less, but it's an average 2% return, and person B doesn't negotiate, so they just get the average 2% raise, versus person A says, you know what, I'm gonna negotiate my salary, and instead of asking for the 2% raise, they're able to negotiate an average 6% raise a year, which means in year one, person B is getting $1,200 more over the year, versus person A is going to be making $3,600 more over the year. It's a difference of $2,400 a year or $200 a month, so really not anything crazy, but it adds up and compounds over time. 10 years later, person B, after getting this 2% growth a year, is going to be making $73,000 a year, which is, yes, more than this, but person A is now going to be making $107,000 a year. A lot more than person B, because now these raises start to compound and compound and compound because person A kept working for a little bit more money each year. But this is where it also gets more interesting. Not only is person A making 50% more than person B in 10 years, but over those 10 years, person A also earned an additional $130,000 over those years through these raises. So yes, it pays to ask for that raise early. Now here's a couple tips. When you go and ask for that raise, if you just say, hey boss, give me more money, there's a good chance they're gonna say no. You have to demonstrate your value. If you're asking for more money, show how you're gonna make more money for the company. The best way to earn more money is to make more money for your company. So if you're gonna ask for more money, show what you're gonna do more, how you're gonna do it more, and how this is gonna drive more money for the company. And if you can show that, well, it becomes a no-brainer, because if you're making more money for your boss, they're gonna wanna make more money for you too. Now that you know these 7 money decisions to avoid, it's up to you to actually take action and not do these things that are gonna hurt your money. Again, if you want some additional resources, you can check out Market Briefs and get my investing masterclass. I have that link for you down in the description. And if you enjoyed this video, the best thank you is to share this video with a friend or a colleague to help spread the word and to spread this financial education. If you make $80,000 a year from your job, you need to make $80,000 a year from your investment income to be able to quit your job and live your life without changing anything you're doing. With your job, you have to go into work every single day to keep getting paid. With your investments, once you put your money to work, it'll keep paying.